me now bring on board Adrian Mowat. Adrian, good morning. Thank you for joining us. Would you agree with our assessment that Thursday morning there is good and bad both, depending on whom you are asking?
Yeah, so the good is that the US economy continues to have strong momentum. The household sector is benefiting from a strong labor market. And obviously the bad news, as you allude to, is this means that US rates remain higher for longer, means the dollar tends to be a firm situation, particularly in contrast to some of the Asian currencies like the yen, where the Bank of Japan is going to continue to run a very accommodative monetary policy. So it's a sort of classic sort of tough environment for emerging markets, this strong dollar environment, this high interest rate environment.
So do you think this entire risk-on rally in emerging markets now naturally because of global macros could come to a pause, because it's been a good year in general for emerging markets?
Well, it hasn't really, because the largest emerging market, which is China, is having a very poor year. And so, out with China, we've seen a little bit of strength in some of the large cap tech stocks in Taiwan and Korea. India's proved to be a bit more resilient. But it's not a strong environment for emerging markets. And because China is doing poorly, then when I speak to emerging market fund managers, they're trying hard not to have redemptions, and in many cases they are having redemptions. And I think to some extent, India is suffering from the problems in China, because that's leading to people being very circumspect about investing in emerging markets.
Okay. Adrian, if the template for US will be strong, indirectly, what do you think that means for the world? Because if the biggest economy in the world is growing, that's actually not bad news if you just think about it.
No, I agree. It's good. It's, that to have an economy, a global economy that continues to expand maybe at a more modest pace next year in itself is not a bad thing. And, growth within your economy in India remains quite robust. We're seeing okay activity in Southeast Asia and the big economies like Vietnam, Indonesia, etc. In Central America, there's a little bit of easing going on. So there is some good news out there. But I do think there's a very important market that we need to talk much more about, which is the long end of the bond market in the United States. So bond yields have now moved up to around the 4.4% level. Now, the yield curve in the US remains the most inverted that we've ever seen since Volcker was in power as the central bank governor, or the Powell equivalent. And when Volcker was in power, short-term interest rates went as high as 20%, and you had an inversion that arithmetically was a bit bigger than the current one. So we've got a US economy that looks as if it's more resilient and an inverted yield curve. And people put a great deal of store behind the yield curve as if it's this, a divine indicator that can't be argued with. I would suggest that the yield curve is wrong and that US bond yields need to move higher. And to some extent, we're seeing that going on as people say, look, if I can get 5.25% in a money market fund, why am I getting a lower yield taking on duration risk when the economic data looks good? And so I think for this year, it's going to be the sort of pain trade is bond markets being weak, bond yields moving higher. And as bond yields move higher, then your discount rate, your key discount rate is moving higher. And so that puts a little bit more pressure, particularly on asset markets like infrastructure, property, which are very sensitive to cap rates, to discount rates.
But Adrian, does that at large also spell bad news for equity markets as an asset class?
Well, I think it impacts equities where the discount rate is important. But I would suggest that where I'm much less worried about the equity market than I would be worried the listed equity market than I'd be worried about private equity, than I'd be worried about property markets. Because at the end of the day, the move that we've seen in the US equity market, I know a lot of people want to just put it down to AI, but if you look at what's happened with the very large cap stocks, their free cash flow generation has accelerated meaningfully. And so there's been a good fundamental driver. If global economy continues to expand, then the earnings outlook is probably more resilient than people expect. So equities, I think, would rank much higher than bonds. But yes, be sensitive that you've got the right conservative discount rates when you're looking at valuations.
All right. Thanks very much, Adrian. Good to have you on board as always and give us a better insight as to how things are trending across the globe and what you made of the Fed rate decision.